Could you share with us an investment mistake in the fund history and what lessons were learned from that mistake?
Oh, yes. Well, we've made mistakes in the past. We will make mistakes in the future. We try very hard to avoid mistakes. Uh, I think Buffett says that 30%, a third of his mistakes are, a third of his investments are errors. So even the best do make these mistakes. So there's one glaring error some of you are familiar with. In fact, many of you were involved with, and that error was with Horsehead. So there were so many lessons learned when we got involved in Horsehead. And why don't I just list off a few? So the scenario was that management was providing false information, in fact, fraudulent information to the public. We ended up pro se motion with Guy Spear. We ended up fighting in the courts in Delaware. In fact, many of you are there. I see Robert right here on the screen. I know many of you throughout that, because of that process, as painful as it was, meeting many of you, like Ed George, who I see here, was a huge highlight. And so what did we learn? We learned that, first of all, as a business, we were relying on a very complex factory to be developed. And that the entire success of the business was dependent on that factory developing appropriately. And that was a huge risk that we didn't really consider because the engineering was so complicated and it wasn't presented fully to the public that it was very hard to tell where they're recycling steel, this electronic arc furnace dust, and they had all sorts of cathodes and chemistry and things. And very late in the process, the engineers determined that they had built or constructed this wrong. It was going to be too costly to repair. And they did a pre-packaged bankruptcy deal that was orchestrated by some funds, as well as some legal teams and the management. And it was really disruptive. We had a nice, solid position. It publicly looked very undervalued. Privately, they were exploring alternative options. And ultimately, we had received a very small payout. We were validated by the judge. It was truly not a bankrupt entity. However, the cost overruns and things, was ultimately rewarded to the debt holders. And so it's very important to know who the other shareholders are within the business that you're owning. The other shareholders can be an asset, and most firms don't think about it that way. Berkshire Hathaway thinks about it that way very much. They take a lot of care to find and attract the best shareholders because they recognize it's going to be valuable in time. So it's really nice to go into a position and know that there's a high quality, large shareholder who has our similar interests in mind. So if we see that Buffett has a large holding, or Bill Ackman has a large holding, or even Eddie Lampert has a large holding, we know that if we're aligned with their share structure, at least they can maybe be pushing things and we can aid them or assist them to push things in the right direction. We also learn to recognize how dangerous debt is. It's surprising to acknowledge that we weren't recognizing it, but the operating leverage is very real. And we see that playing out in Seritage in real time again today. The small change in the cap rates are causing massive swings in the valuation of Seritage properties. And it's all affiliated with the operational, with the operational leverage that they're using. One thing that we've noted and added to our checklist as a result of Horsehead is something we failed to do at the time was go and look at the debt instruments, go and look at the publicly traded debt instruments. It's very interesting because a lot of the folks who are trading commercial paper are looking at things in a different manner than those who are holding the equity. But the commercial paper is higher on the capital structure than the equity holders. The equity holders get what's left over after they pay the debt. And so what happens is there are times when equity holders are rallying around some great value opportunity, and you go and look in the publicly traded commercial paper and it's selling at a 40 or 50% discount to par. And that's a huge red flag. So the debt holders oftentimes discover something going wrong that the equity holders have missed. They're higher on the cap structure. They're concerned about getting their par value back. So if something starts trading at a large discount to the par value of the commercial paper, it's a very nice leading indicator that something might be wrong. And those are a few of the things that we learned out of Horsehead. We have a very thorough post-mortem analysis that we do on our exited positions. We like them all to work out. Inevitably, some of them do not work out. Thankfully, we avoided that fate with Seritage.